think it is noon, and we've got a number of people already waiting. So let's get on with it. So thank you. Welcome to the 8th annual Badger Startup Summit. My name is Alan Dines. I'm the co-chair of the event, along with Matt Yonkel. And this year, obviously, we are virtual. We have compressed what is normally one-day event into this 1-hour fireside chat, actually just Five Lakes chat, we're calling it now. And we have a condensed version of the pitch and replay event coming up following this at 1:30. That'll be on a separate Zoom call, by the way. I'm going to need to share my screen here for this next couple of comments. We are part of the Forward Festival, and the Forward Festival is in its 10th year. It is an event that is put on by entrepreneurs for entrepreneurs, starts today and goes through the 20th. And there will be about 40 different events following this one that all have something to do with entrepreneurship. These are the sponsors of the festival, so I want to acknowledge them and thank them for their support. Also, with respect to the Badger Startup Summit, we have a special thanks for Wharf. It's their sponsorship this year has made it possible to do the virtual summit. Also, we've had great help from Generator, Macon Hay Communications, and Merlin Mentors to put this event on. So, what are we putting on? This year, we are excited that we're partnering with Five Lakes Institute. Five Lakes Institute is a regional high technology collaboration network. In short, Five Lakes does regionally what we have been working on doing with the summit for many years locally. So we really appreciate this chance. I think there's some great synergy. What are we going to talk about? Much has been said and done about getting startups started and nurturing them and getting them to some kind of market traction. But the question is, what happens then? What's next? And what we've done today is we've convened 3 veteran company builders. And we're asking them to talk about the challenges and importance of planning for scale to achieve meteoric growth. Kathleen Gallagher is going to moderate that discussion, and she will introduce the speakers. Kathleen, I've known for many years, and I've always thought it would be really cool to work with her. We got together earlier this year and talked about how the summit might fit in with Five Lakes, and this is what we've come up with. Kathleen is a Pulitzer Prize winning journalist. She spent about 20 years with the Milwaukee Journal Sentinel covering the business and tech scene. She's now executive director of the Five Lakes Institute, and in her spare time, she does a few other things. She's a columnist at Biz Times, an entrepreneur in residence at UW-M, a board member at Starting Block Madison. I'm probably leaving some things out. Oh, she hosts a radio show. How did they do that on Milwaukee Public Radio? So with that, I'm going to turn this over to Kathleen and take it away. And we're looking forward to hearing the discussion.
Thanks, Alan. And thanks for the collaboration. It's great. You know, Alan for years was at University of Wisconsin-Madison in the Office of Corporate Relations. So his contacts across the region are extensive and robust, and it's just really great to work with you. So thank you. I just want to do a little housekeeping. We've got, we've turned off the chat. The Q&A is on, and I'll be watching the Q&A as we talk. We have a lot of things to talk about, so we may not be able to integrate all the questions we get off the Q&A, but we will be watching it and we will follow up with some of it if need be. But I want to get right to the panelists. They all look so serious. This is, we have to have more fun than the way you guys look. This is really a pleasure to introduce the 3 of them. All of them have accomplished so much, and you can read the bios. I'll be real quick, but John Byrnes, who is chairman of Five Lakes Institute, ran the private equity at M&I Bank, the biggest bank in Wisconsin, that was ultimately acquired by BMO, and spun out their private equity group into Mason Wells, which has been an amazingly successful private equity firm. He's built many companies. Tom Erickson, the relatively new founding director of the UW-Madison School of Computer, Data, and Information Science. I'm convinced they're doing that name because they want someone to buy a new name. You're right. Tom, it's really special. He doesn't have a PhD like you would expect someone in that position. He has an undergraduate degree, but he went to Boston after graduating from Madison and was founding board director, chairman, and CEO of Acquia, a Boston company that was bought, well, a private equity firm bought a majority stake late last year for $1 billion, a cloud platform digital experience management company. So he knows how to build companies. And then we've got George Roberts, who's a partner at Boston-based OpenView Partners. He was previously executive vice president for North America at Oracle. He worked directly for Larry Ellison. He was responsible for more than $1 billion in revenue. He's obviously was involved in the building of Oracle, along with a whole bunch of companies that OpenView's been involved in, and he lives in the Milwaukee area. So great asset to our community. It's wonderful to have all three of you here. Thank you so much for doing this. We're gonna start with kind of a think bigger theme. And the goal here is to have me not be talking so much and the three of them having a conversation. We're not going to do the boring question and everybody answers it. This is going to be a real conversation. So let's just start with the idea. Our region definitely has more startups than it did a decade ago, but most of them don't scale. And that's what we're here to talk about today. You know, how do we get more unicorns developed in this region? Why don't they scale right now? Whoever wants to start, this is a conversation. I'll start with Tom.
Well, I don't know that there's a couple of perhaps reasons why we're not seeing a lot of companies scaling. Having said that, the trend is a positive one. And we have had some great examples of companies that have scaled, whether that's Exact Sciences, who moved to Madison from Boston, or Epic, also in the area. And then, of course, 100 years ago, we were leading much of the country in terms of building entrepreneurial companies. But what's happened in the meantime is that the coasts have dominated the innovation sphere in North America, actually. And a lot of that has to do, well, I think there's two reasons, and I know George is really capable of talking about one of them, which is thinking big. The other one I'll put forward is that we don't have as many mentors today, any people capable of judgment that will help these folks at the same scale that the coasts have. So being in Boston for most of my career, and if I ever needed something or a question, there were 20 or 30 people I could go to and ask and get, have breakfast or do something with. And that's a little bit harder in the Midwest. And so, my answer to that is we have to work harder and find that, and maybe reach out, maybe this notion of COVID and learn to do things, via Zoom means that maybe we can get some of that mentorship, and it doesn't need to be local. So George, I'm going to turn it over to you because we've talked before about the need for the ideas themselves, right?
Well, I think, first of all, I think to build a successful company, you've got to solve, a complex business problem that people are willing to pay for, right? And it needs to be in a big market. It can be a big vertical market, or it can be a big horizontal market, but it's got to be a big enough market you can actually build critical mass around it and build a company around it. And I think that oftentimes too many founders start with a feature and they never get it to the product level. And then when you get it to the product level, then you need to get it to the platform level, right? I mean, if you look at all the successful large corporations and software and stuff, they all might have started with a feature, but they quickly became a product, and then they quickly found a way through vision and execution to become a platform within their marketplaces, right? But they were all big marketplaces, and they were all solving complex business problems.
I agree, George, but you've said a lot of things in that statement. Let me back you up and ask a question. What's the difference between a horizontal market and a vertical market? Are they both equally large, or are some bigger and some smaller?
Well, horizontal is always larger than vertical. It just is, right? Because it cuts across all industry levels versus.
What are the characteristics of a horizontal versus a vertical market?
Horizontal says that you have a solution for any industry that has the same complex problem. So a horizontal solution in technology would be databases, and applications would be manufacturing applications or financial applications, versus a manufacturing application designed specifically for the pharmaceutical industry with an emphasis on process manufacturing.
Mm-hmm. Okay. One of the things that I've noticed about thinking big in this Midwest region is that it usually starts out with trying to identify a market. And yet when you talk to the coastal players, they frequently want to go after green space, open space, things where there really is no so-called market. So how does an entrepreneur today think about that? I mean, one of my pieces of advice is find a space where nobody's doing it. If somebody's done it before, a lot of times good deals come to me, good ideas come to me, but they're number 3 or 4 already. I mean, other people are already doing these things. And my thinking about technology is that if it's a good idea, you can almost be guaranteed there are 2 or 3 other people that are working on some solution to that problem right now. So you have to move quickly, and you have to work on markets that you can develop and redefine the space, as opposed to doing something other people are already doing. That's been what I've looked for with growth opportunities, as opposed to, then you don't have to fight with the competitors for the business. You just have to fight with the mind share of the buyer, which is something you can try to change. I don't know. I don't know if that makes sense.
Yeah, I agree with you to a certain extent, John, although I think there are some very big markets. A former alum from Acquia helped start a company called Toast, and Toast rapidly grew in the restaurant POS system. Now they've had a tough time under COVID, but it's one of the fastest growing companies in America. Now there were solutions out there for that. In fact, Oracle, George's former employer, bought the big one called Micros that really dominated the space, but they used old technology, and Toast came out using iPads and using modern sort of communications and capabilities, and really redefined that market, which had existing players in it, but a chance to just totally disrupt it in the way that they looked at it.
So in that sense, Tom, a big market is one that has a lot of potential buyers.
Yes. Yep.
Versus a smaller market where you may only have a few hundred.
Correct.
Okay.
Now, there are niche plays where you might only have a few hundred. A good example, the name of the company is escaping me. George, you might remember, when Salesforce came out and built and became the dominant horizontal solution for CRM, there became a vertical solution for CRM around life sciences and pharma. And the number of companies in the area was smaller, but each of them was massive in size and had a massive need for this kind of capability, whether it's managing clinical trials or managing other types of information. And they built that into a public company as well. So there are innovation opportunities, but they all have that characteristic of a large total addressable market, a TAM, whether that's a vertical or horizontal situation.
And what's interesting about that company, Tom, is actually the founders and stuff originally built the vertical industry within Siebel for pharmaceutical, right?
Yes, exactly.
They left Siebel and then they started this company, and the original, one of the major investors was Craig Ramsey, and Craig was a CRO at Siebel and then was on the board at Salesforce. So, I mean, they're replicating a playbook, and what they're doing is they're coming out with a totally new way to deal with antiquated business processes within the pharmaceutical industry, because things had gotten too complex and hadn't kept up with what the business needed to be done, right? So you can do both. You can shoot for green space, or you can identify a complex problem that hasn't had a modern solution for 20 years. And both can be very, very successful. And another example like that would be Instructure. Instructure came out and took on Blackboard, the universities hated Blackboard as far as an LMS system went, and they couldn't wait to go to a company like Instructure for a more up-to-date solution that made their lives easier. And then Instructure went public and then got bought by Thoma Bravo. So another example.
So let's talk about, if you're thinking bigger, how do you use use cases to further your idea? That seems to be something that doesn't happen. People have said to me, use cases aren't used as well here as they are on the coast.
By use cases, you mean how the product is used and how it's applied, and it's
and how you partner with potential customers. You know, how you figure out, you've got a technology, how do you figure out how that technology is going to be used in the market, what's the best applications are, that sort of thing.
Yeah, well, we've talked a little bit about this before. I think part of the problem is the thinking bigger of the entrepreneur themselves. And I don't want to make, you know, us feel like the Midwest is inferior. You know, sitting in Boston as I did for most of my career, and George has been investing out of here and working out of here. You know, there are a lot of feature-oriented companies in Boston. There's just a lot more companies that people are trying to take to market. And there's a lot of people that are encouraging them every time they talk to them to think bigger. You know, what is your bigger problem? You know, as far as partnering, we have some good examples of companies that partnered. Epic is a great one. You know, Epic was kind of a company that's doing well, but it wasn't really big until it partnered with Kaiser Permanente. And Kaiser Permanente really took them into the big time. I worked at a company, it was actually founded in the Netherlands, believe it or not, so it wasn't even a US company. Competed with George's company, it's called BAN in the ERP business. And we were struggling until we got a partner called Boeing, you know, and Boeing suddenly, you know, became a name that we could say, hey, if you can work with Boeing, you can work with us. And so that partnering becomes kind of an interesting way of establishing credibility as well as building better product.
I looked at a company the other day that was coming out of Milwaukee that is interested in working with cheese companies. And what he had was a software as a service application that was going to put sensors into cheese plants. A typical cheese plant has 5 or 6 tanks with different biometrics in them that you need to monitor on a constant basis in order to control the quality of cheese. And I said to him, how big is the market? And he said, well, there's about 300 cheese plants in the country. And I said, well, is there any adjacency that you could use? And so we started talking about adjacencies, and we ended up with fluid processing as a more generic, higher level concept. And when you talk about fluid processing, now there are a lot more verticals that you cover with it. So I think that's the idea, is that are there adjacencies that you can bolt on once you go after cheese plants and get that done, develop customer base, develop referenceable accounts, develop your infrastructure and your application, and then see if you can add other sensors, other markets, and grow rapidly that way. And
the important thing about that is the important thing about all of that is to have the vision, right? And which also leads into the ability to get funded, because if you don't have an interesting story around a complex business problem and a big market, it's tough to get funding. And so to have that vision and to be able to tell that story allows you to actually build funding to get into it and be successful, right? But if you haven't got that story, which when you were talking to this founder, he didn't have that story yet. But now he has something that's a lot more interesting and a lot larger to talk about solving a complex business problem.
How much does the business model play in the scalability of a company? In other words, one of the issues that I've run into in Great Lakes companies is they make things, they make a physical product. And their P&L, their business model, profits as a % of revenue. At the gross profit level, start at 45, maybe they're 50% of their revenue they get to keep after they've made the product. And the marginal cost of building one more unit is very high. And so when they get down to R&D, they've only got 2 or 3% of revenue that they can spend on R&D. So that business doesn't scale very well. Whereas in other types of businesses, particularly in information technology, you have a totally different business model. You have 80, 90% gross profit margins. You have 30% of revenue you can put into R&D and still produce 20% profits on sales. That model is far more scalable in the sense that you can grow rapidly because the marginal cost of adding another customer is very small. And a lot of the people in the Midwest, I think, and this isn't a criticism, they're used to making things. They're used to making physical things, and they think that way about it. And they don't get the notion. I mean, most of the people I talk to about the tech companies, you know, I say, look at Facebook's income statement. And they look at it, they go, man, they make a lot of money, don't they? Absolutely they do, because they have a business model where the marginal cost of a new customer is zero, right? I don't think most entrepreneurs in the Midwest get that. At least that's my take on it.
You know, business models are really important even within the information technology world, and they can dramatically change how people do things. So, for example, in the case of Toast, this really fast-growing company that went from sort of start to 3,000 employees in about 5 years, they created a business model where effectively the restaurants, these small restaurants, were leasing the equipment, so there wasn't a big upfront capital cost. And so Toast would go out to their financiers, get capital, and create leasing programs. Their turnover, their churn was so small that there was a lot of confidence that this would work. And so they were able to acquire customers at an unbelievable rate. And that quick acquisition of customers with long, what's called total lifetime value for each of those customers was an amazing business model that was a dramatic shift from the business model of their predecessor, where if you wanted to buy Micros solution, you had to pay for the hardware, you had to pay for everything up front, something that, you know, quite frankly, a lot of these small businesses couldn't afford.
Yeah, George, you said something earlier about the difference between a platform and an app. How do you define those two things? And can you be in the platform business alone, or do you have to have both a platform and an app?
Well, all platforms start as an app, and then they move into other areas of business functionality or process or adjacency, as you mentioned earlier, John.
Right.
And so, you know, all software solutions start as a product, and then they become a platform. And the key is being able to make that transition successful. Not that you can't build a successful software company around a product, but if you're going to build a big software company, you have to move into the platform industry because you're capturing a larger quality or a larger portion of the market or the wallet of the client and the market, right? And what Tom talked a little bit about, which is business model is important even within the software industry. If you look at the latest companies that have replaced other software companies for market domination, it had to do with their business models, right? Oracle has their business model. It's expensive, it's archaic, it's old, and it's slow. And someone comes out with a newer business model and a newer approach to the marketplace, which is what, you know, the latest trend is all about, which is product-led growth, right, within the marketplace. And so, you know, product-led growth is all about designing for the end user first, right? It's about delivering value before capturing value. It's about investing in the product with go-to-market intent. And if you look at the latest large public company successes like Zoom or Slack, or one of them that OpenView was involved in called Datadog, they're all product-led growth companies. And the approach takes a lot of friction out of the decision-making process so people can arrive at a decision sooner on whether they want to actually use your product or not. And that's really, really critical to being able to scale with efficiency, because if you take friction out of it, it means you can scale faster and more efficiently.
The friction you're talking about is the difficulty the customer has using it?
There is friction in everything. It's not just difficulty in the customer using it. It's also difficulty in the customer being able to make a buying decision, right? Based on your business practices, based on your pricing model. Tom's discussion around Toast, they came out with a pricing model that was totally revolutionary to the marketplace, that undercut how the traditional vendor was doing, and they came in and they took their marketplace away, right? So it's all aspects of the model. It's not just product, but it's also business practices. It's your pricing model. Pricing is every bit as strategic as software is.
I would add, it's also your sales model. So, you know, another great success story is a company called Atlassian, and they built a company out of Sydney, Australia. And you think, well, who can build a, you know, major public company out of Australia? And they just reduced all the friction in the buying process, including eliminating salespeople. So developers who are their users didn't ever have to chat to salespeople, and turns out developers don't like chatting to salespeople. So, you know, they innovated in that side. So another great example of what George is talking about.
Yeah, Atlassian is probably one of the first of the product-led growth companies, right? And they focused on delivering value before asking for any money. They delivered it quickly. They introduced customer success to the clients ever before anybody got involved, right? Because it's all focused. The quicker you can make a customer successful with your software, two great things happen. Number one, they're going to become a reference, so they'll tell other people how your product is making them successful in their business, which is the best way to sell. And the second thing they're going to do is they're going to buy more of what you already sold them. And that's the magic behind getting the flywheel done.
What do you think of the notion of giving away the software, the app, in order to get the data, which is a big thing I see a lot today? Just give away the software, give away the app to get the platform business and the data that's associated with it. There's some deals being done, for example, in the insurance industry, where software companies are coming in and say, give us all your data, we'll de-identify it, give it back to you in a summary form, and we'll give you the software to do that.
Totally fine, as long as you can extract value from the client, right? And that's just a different business strategy for how you extract value from the client, which at the end of the day is the only way you can build a company. Somehow or another, you have to deliver value. And if that's a different approach and a different strategy versus the way it's done currently in the marketplace, it can be very successful.
There's a lot of history in, you know, these data companies, and I hesitate to call the ones that are doing that business model, John, software companies, but it doesn't diminish the fact that they're very good business models. And AC Nielsen, of course, did this a long time ago.
Sure.
Someone in the drilling business, a company called Drilling Info, happened to have, you know, pull all the drilling information from all of the petroleum companies around the world, and it became really valuable. And a subscription to Drilling Info costs you, you know, well into the 7 figures every year, because the risk associated with you not learning from what your competitors were doing was huge. You could have spent hundreds of millions. So for you to think about spending single digits of millions, so there are some amazing business models around data, but I do hesitate to call them software companies. Yet they are entrepreneurs. So,
well, the one that I'm familiar with from years ago is the whole business of tracking automobiles that leave Detroit headed for dealers. They go mostly on rail cars. Rail cars have no digital identification system, and so there's a company in the automotive industry that makes about $300 or $400 million a year simply tracking the vehicles, and they have to do it physically by having agents that go around to the railroad yards to find the cars and get them along to the right destination. That's an example of an ancient technology that was built along the lines of what you were talking about, that probably needs to be teched up somehow with RFID tags and things like that, but nobody's got around to doing it yet. But could be a big market for somebody.
So you guys took us to ingredients for successful scaling, and we've talked some about business models. Should we move into other ingredients for successful scaling? People. How do you think about the people you put into these models?
Well, I mean, we talked a little bit about this before. People are the most strategic asset you have, right? It's the people who build the product. It's the people who sell the product. It's the people who service the customers. If you look at any great software company, any great company, they all have more great people than their competitors do. Now, not everybody's going to be an A player. It doesn't work that way. But people are the key to building successful companies. The combination of people and culture are how you break through and make this work.
I agree with that. I had a conversation with Rich Tierlink, who ran Harley Davidson years ago, and I had him give a speech to our team about building a competitive advantage, and that was his point, that your only competitive advantage is the relationship between your employees and your customer, and how they react and relate to one another and identify with what you're doing as a company. I thought it was an interesting point of view, and I agree with it. People are the key. So what kind of people do you think you need? Are there categories of people that need to be on hand to build a company? Which is the most important? Sales, operations, finance?
They're all important at different stages as you build your company. But the one thing I'm going to say is nothing happens if you don't have a product.
Right. So product development, but nothing happens if you can't sell it to anybody either.
Well, but that comes second without a product.
Yeah. Right.
But product is key. And again, designing product that's easy for people to make decisions around whether or not they want to move forward with, which is, again, this whole latest trend around product-led growth, right? Because if the product is simple, if it's simple, it's easy to try, we get value out of it before you ask me for $1 out of my wallet, right? Those kind of things are really, really valuable in allowing a company to get traction within their marketplace and then quickly spread throughout a specific segment of the market. And
So you let them try it free?
You may, or you reduce the price to the ridiculous, which is what Toast did with Tom, right, Tom? They essentially took the big upfront cost out of it and said, here's how you can get started with a much better product and a much better business process. And it took a lot of the risk out, right? It didn't require heavy capital investment. Or in software like a Datadog, I mean, or a Calendly or an Expensify. Someone can whip out their credit card and put $50 down and away they go. And next thing you know, they're starting to send calendar invites with Calendly and all their people join in that they're in their calendars, right? And companies like Expensify or Calendly have found a way to do that very successfully.
I'd like to add to this notion of product and the importance, especially with this concept of product-led growth, which is really the, George hit on it. It's the big sort of recognition of things over the last 5 years in entrepreneurship. I've been working with a professor out of Georgia Tech who's also an entrepreneur. He was on the West Coast and then built some companies out there while he was at Berkeley. And he's had 9 years now in Georgia of running an accelerator. And they were running the accelerator at Georgia Tech, where they've also been studying what makes a successful company. And they're starting to now bottle up what their learnings are. And the first, and to me, the most compelling thing is I think about my own entrepreneurial experience. I could never categorize it, but he describes it as the no-no concept, which is the customer does not have the option of not being a customer. And if you think about what does that mean, is that your product is so compelling, is so needed by that, or wanted or desired, or you choose your verb, by that customer, that regardless of everything else, they have to have it. It's the same concept that, was written about Oracle in the days that you were there, George, about being in the tornado that Jeffrey Moore wrote about in his Crossing the Chasm and Inside the Tornado, which is at some point in time, everybody had to have that Oracle database. It didn't matter. What Jeffrey Moore would say is, forget about your customer service for a while. You just have to take orders. And that's when you know that you've got to that point where the customer cannot say no to being a customer. That's not an option. Then you really started to hit it. And I thought that was the most brilliant way of succinctly describing what everybody needs to seek. So,
well, what we hear today a lot from incubators and startup companies is this notion of a minimum viable product, which I think George is talking about too. You have to have a product, but what you're suggesting is it needs to evolve into an overwhelming value proposition, the not,
Yep.
right? You must have it. And trying to do that by sweetening the mix of offerings, by making the user interface frictionless, all the things George was talking about before. You know, it's difficult to say there's one thing. It's more than one thing. It's always a collection of features and functions that make it all work. You know,
you have to be able to you have to be able to establish measures in your customer acquisition process and understand these friction points. So back to this term before that George and you have mentioned, John, this frictionless environment. That should be the focus of anyone starting a company, is how can I reduce all the friction points that help me acquire a customer and then retain that customer.
Totally agree, which means you need to be data driven. You got to run experiments, and you need to have velocity in your processes, right? So you can continuously improve your product offering, your go-to-market offering, your customer success offering, et cetera. So you get that 360-degree life cycle in the marketplace around your solution. And as you said, Tom, the pain's so great. I used to call, everybody's from Missouri, right? They all say, yeah, I love what you're telling me, but prove it to me. The ability to have a compelling story so they actually have to look at you, and then being able to prove it quickly to get them to that decision point is really, really valuable. And then being able to make them successful in the shortest possible period of time. So number one, again, they're referenceable, and number two, they buy more.
George, what do you mean by data driven? I use the term myself. I just wonder what you mean. You mean sales data driven, understanding the data metrics of your customer, of the market? What type of data?
All aspects of data around product usage, right? Data around not just go to market, but data around how your customers use a product, data around where they're finding issues that create challenges for them that slow down the adoption or the values delivery within the client and things like that. Being data driven is how you make the right decisions, right? The worst decisions I've ever made in my life were emotional, other than deciding to marry my wife, right? So
Glad you said that, George.
But we live in a very emotional world. Emotions are supposed to trump reason these days, but I agree with you. But the point I was going to lead to is that in the data-driven analysis, for example, you take a look at customers as a small company is developing customer relationships. Rarely do all those customers buy for the same reason, in my experience. So what I encourage small companies to do is disaggregate your customer base and figure out how many different value propositions are there, and then segment your marketing so that you can target different personas in your customer base, because they don't all buy for the same reason. Even though you might only see one reason, others see other reasons. And I guess, a classic example is everybody uses a smartphone differently. Everybody uses it for different things. I mean, somebody says, well, I think the best part about a smartphone is this, whereas somebody else might have a different value proposition in how they use a device or a piece of software.
I agree with you, John, with a caveat, which is early stage. I don't know, our audience here is going to be a mix of early stage and later stage companies. Certainly, if you take Oracle, what they did as they grew is eventually they came up with different flavors or different views of their product for different types of personas. But for a young emerging company to try and think like that ends up sometimes basically creating separate products and not enough focus around getting success around
getting penetration, getting market
penetration, right?
Yeah.
And so I was on the board of a company. It was a very early stage. A friend of mine said, hey, you should meet this guy. Happened to be in Scotland, and who doesn't like to go to Scotland if you like to golf? And so I said, oh, I'm on board. And I got there and I realized that they had 5 customers with 4 different use cases, and they couldn't figure out which path do we take. And so where do we, with our incremental dollars that we have to invest in R&D, which customer do we care about more, and which features do we add now? our product. And so we basically scrapped that whole thing. We started over, and we came up with, believe it or not, we got rid of all 4 of those previous use cases, came up with another one, happy ending. The company eventually got acquired by SAP, and now it's a key part of their e-commerce solution. But you do have to be careful as a small company of splintering your value proposition.
There's a good question in the Q&A that I thought we could come back to this idea. You guys were talking about product level and platform level, and just kind of what the characteristics are of each, how entrepreneurs should think about the product level when they're building it, and then the platform level.
One comment I'd make, Kathleen, is that you have to distinguish between the business platform and the technology platform. People talk about those interchangeably, but they're quite different. And technology platform gets into the stack and what you can get as infrastructure as a service and what you need as platform, and then the applications. And is it just your application, or you allow other applications? They can mean different things in different conversations. A business platform might be more about, as I think Tom was talking earlier, about how you go to market, what your pricing model is, what your product delivery system looks like. But there's a lot of conversation today about platforms. In fact, I was talking with David Conjugal the other day. He's the retired CIO in the state of Wisconsin, and we were talking about IoT, and he was saying, I think IoT should be IOST, Internet of Secure Things, because the biggest friction right now in IoT is security, which is a comment I was going to ask George about. As in the industrial IoT space, everybody wants to do it, but the security issue is a big impediment. Figuring out how to eliminate that issue is something that would help a startup company grow very quickly, because that seems to be the primary concern right now in the industrial IoT space, at least as I see it.
George, you have thoughts about that?
I can't comment a whole lot about the IoT space. I mean, I've spent some time there and everything else. Security to me is probably overarching of all of IoT, and particularly because there's so many pieces in IoT, right?
Right.
And so it's probably going to require a separate security solution to make that work. I'm not sure a single IoT company can make it work, because everything needs to work together, and there's so many different pieces of it. I mean, it's such a young market. It's going to take some maturity, and it may take several generations or evolutions before they actually get there, right?
Yeah.
You know, if you look at all software industries, there's lots of companies that start and fail, and then sooner or later somebody gets it right, and next thing you know, it might have taken 10 years, but they're considered an overnight success, right? And
well,
so
isn't that the thesis of Play Bigger? I don't know if you guys have read that book, but 10 years is the milestone for the breakout moment. It's not 2-3 years.
I used to work with,
the average breakout point is in 7 to 10, right?
I used to work with the author, so I lived that every day.
Did you like their book? Have you read their book, Play Bigger?
Well, I love his. I haven't read the book because I was indoctrinated to his thinking.
Yeah.
As my CMO, we sold a company I was the CEO of to him, and he was one of my colleagues there. So I like the idea. I want to go back to the question about product versus platform, though, because I think it is really a tough thing, and I think George has some good insight. But before I do that, I want to talk about another great entrepreneur named Godfrey Sullivan, who used to be the CEO of Splunk, and he was also, for a very short time, the #2 guy at Salesforce. And Godfrey is an amazingly wise individual. And as he took Splunk, which was a data play, they basically collected logs out of computer things, just lots of logs, and said, maybe there's something useful in all these logs. And they created a product that helped you read your logs and do diagnosis and things like that. And he always had the philosophy was, we're never going to call this a platform until our customers call it a platform. And they kept trying to add new use cases. And that's what they did, is they'd say, okay, here's a use case for these logs. Here's another use case. here's another use case, in their attempt to make it impossible or get to this no point of saying a customer just can't, it's not just one use case, they're using this for all these things. Now a customer's coming and say, well, you're a platform that I can't get rid of. And the customers would declare it a platform. And I thought that was a brilliant way of thinking about how do you move from product to platform.
I agree with that. An interesting question would be, how does a startup company iterate their use cases? How do they go about doing that? Is it conversations with the customer, or is it brainstorming with their people? Is it some brilliant guy that you put in a room and don't give him any food till he comes up with a bunch of use cases? How does it work?
I'm going to talk on this point because I worked with a gentleman out of Chicago that built a company, and it was really interesting when the first acquisition by a private equity company came before they later sold it to SAP. I told Jay, I said, you're one of the few entrepreneurs who had a vision, and 10 years later it actually happened, right? His direct vision. And Jay said to all of our CEOs once in a conference we had, and I truly believe this, that everything's around that customer, but your product strategies should be the perfect shadow of the customer's needs. But the most important qualification here, or clarification here, is that they're willing to pay for.
Exactly.
Customers ask you to do things all the time that aren't good for you as a company, but they're good for them. You have to be able to say no. And if they're not willing to pay you for it, don't do it. And by the way, your engineering teams have all these great ideas, the interesting things they'd like to build. But if you can't charge for it, other than quality, right? It's a waste of your precious resources of capital and people.
I have an amusing story, George, to follow on that concept. In the late 80s, I was living in Europe and working for a US technology company, trying to expand our market to Europe. I got into Germany. We were selling a maintenance management solution. We were basically kind of first people into market. And we were really struggling in Germany. And I asked our managing director there, I said, what's the issue? He said, well, there's this local software company and they've gone out and they built a maintenance management system. I said, well, tell me about how they built it. He said, well, they used to be in the financial services area, and then they got a customer and they had another customer, and they said, oh, we would like to have a manufacturing requirements planning solution. And the customer, the software company said, well, would you be willing to pay for that? And that customer did. And then they bolted on another solution, and they bolted on a maintenance management solution. And at the time I said, who in the world would ever think that this German software company could ever compete against this American software company? Of course, that German software company was SAP. And we look back on that today, but they built their entire business model off of going to customers and saying, what else would you pay us for to build?
Absolutely. The flip side of that coin, Tom, is that in the buyout business, which I'm familiar with, one of the things that new buyout groups do is they get control of a company and they fire all the customers that aren't paying them enough. And they change the financial model dramatically and quickly. Now, the problem is you can't shrink to greatness. So it does shrink the company, but it does also improve the financial performance. So it's kind of the flip side of the same thing. If a customer won't pay you, don't do it. You shouldn't do it. Because if they don't see value, why are you worried about it?
Well, more importantly, the important point also, John, is that life is too short to have customers who don't like you.
Yeah,
You can't be successful with your product. So
Right.
Going through and encourage them, it's like having a bad employee, right?
Yeah.
Going through and identifying them and just encouraging them to go somewhere else because they'll be happier is a good thing to do. There's nothing.
Absolutely. If I could digress for a minute, one of the real important people in my career was a guy named Jack Puliker, who ran the M&I Bank for years. And I remember I was in my 30s and I was running a little group, and I had some people working for me who thought that we needed more hierarchy, we need more intermediate management. And so I was asking Jack, I said, how many people can you effectively manage? And he said, I can, without hesitation, he said, I can manage an unlimited number of good people, but I can't manage one bad one. Which I thought was really good advice. Really good advice. Don't argue with people that don't want to work, right? Just get rid of them. So anyway,
So let's move to money and funding. You know, a common complaint here is that the startups with the most potential can't raise the amount of money they need the way the companies on the coast can. So the coastal companies have an advantage in terms of getting to market faster, growing bigger, et cetera. How do we solve that problem? Or is it a problem?
well, yeah, go ahead.
Tom. Go ahead, Tom. I'll let you chat first, and
I don't think it's our biggest problem. You know, can we? You know, I speak with George is an investor, so he's the one who can speak to the best. But I'm involved with some companies on the coasts and with large PE firm out of Austin, Texas. It's not on the coast at all, and it's the largest software company in the U.S. So they're like, yeah, if you've got something interesting, I'll come up to Madison or Milwaukee in a heartbeat. So I think there's an opportunity here. Maybe we need to, I think one of our enemies is our own modesty. Those of us that are from the Midwest, like me, growing up in rural Wisconsin, we're taught like, don't push your stuff too much. You're not that great. It's something that comes from Scandinavia, I'm told. And that's one of the things that I think we have to get better at is we have to sing our own praises a little bit louder.
Yeah,
Which is one of the, go ahead, George.
I was going to say there is plenty of money out there for founders who have good vision and good solutions that are needed in a marketplace. And if you can't raise capital, then your story sucks.
Exactly. You're not doing it right. Money is fungible. Now, I will say that it may be more difficult to find mentors that can help you in the Midwest. So if you, in addition to money, you need good coaching. And I think sometimes the good coaches that are attached to money there's a tighter link on the coast than there is in the Midwest. I think, I remember trying to get a California Sand Hill Road firm to do a deal in Milwaukee about 30 years ago. And he said, I don't do deals in the Midwest because the divorce rate isn't high enough. He said, that's a pretty cryptic notion. He said, no, the truth is it's too far to travel and it's too hard. Now that was 30 years ago. Communications are much better today, but I think there is most people that I've known who've been successful in early stage venture, they spend a lot of time with the entrepreneurs, working with them on a daily and weekly basis. And that is hard to do over a great distance. So while money moves, I think the leadership in the investment community needs to be strengthened in the Midwest. I don't think it's as broad and deep as it needs to be to really create.
What I've seen over the years as a reporter is it's a lot of these companies don't have the right mentors. It's hard to figure out who I'd take any one of you three for a mentor. I'm pretty sure of that. But how does a company sort through the potential mentors and figure out who the best mentors are for them?
Well, first of all, I'm going to say a couple of things. The first of all is there are a lot of great sources for information about building great companies if you're willing to actually look and read and learn and everything else. I mean, OpenView, and by the way, OpenView invests in companies all over the place, right? We believe great people are everywhere. We invest where there's great people and great ideas. And so if you look at our portfolio, they're everywhere. They're not just in Boston. They're not just in San Francisco. We've invested in companies in Utah. We've invested in companies in Atlanta. We've invested in companies in Austin. We invest wherever we find great people and great ideas and great potential. The second thing is, I think if you're going to find someone who's willing to spend time with you, you've got to make sure that there's an intersection of interest level and passion. So they have to have a passion for what you're doing, and they have to have an interest level, right? And there might be an intersection because they might have originally been from Wisconsin, or there's a link somewhere. But having intersectionality makes it easier to find someone who will take some time, and then making sure that you use their time wisely, right? And that you also deliver some value to them. It's not just about them delivering value to you. It's you being able to give something back in return.
But how do I know they know what they're doing? Or that they have expertise in the area I'm looking for expertise in?
That I was talking earlier about this individual I'm working with out of Georgia Tech, and he has another philosophy on that, which is you don't know that they're right, and chances are, if you disagree with them, there's a good chance they're not right, you know. And a lot of the things a mentor can help you with is not deciding what's the right way to do something. It's the right way to think about how you will come to your decision to do that. So it's not asking the mentor to make that decision for you. It's asking them to, how should I be thinking about this so that you arrive at the decision yourself? Because there's no data that shows that the mentors themselves are more right than you are.
And to add to that, Tom, and you and I talked when we first met and stuff, I have a standard disclaimer. I tell people I have an opinion on everything, and I'm going to tell you exactly what it is. But it doesn't mean I'm right, because you know your business better than I do, right? So if you want to have good discussions around which door do we want to go through, door number 1, 2, or 3, we'll have good discussions and good debates. I'll tell you everything I think, but at the end of the day, you know your business better, so you're going to have to make that decision.
So,
Yeah,
oh, go ahead, John.
I was just going to punctuate that by saying I used to say about my best entrepreneurs that they only listen to my good advice.
So just, we only have a few minutes left, but anonymous attendee is pushing back on you guys on the capital thing, saying, you know, like, it's really hard to raise money here. And, you know, maybe it's reputational, but startups can't raise the kind of big money here that they can on the coast. So let's dig into that a little.
Well, what is big money? I think you got to talk about that. If you look at the trend lines on venture capital, the A and B round numbers are staying pretty steady over the last 10 years at the 5 to 10 million level. So I think that kind of money is fairly easy to raise. The C and D round charts that I look at, it's moving up into the 50, 60, $70 million range. And that's the influence of the big investment bankers getting into the C and D rounds. I mean, what I see in the numbers is that the big money guys in New York in particular are buying the pre-IPO companies completely. They're buying out the A and the B, taking the thing over and flipping it into the public market after about 2 years and getting 2 or 3x on their money instead of trying to take the high risk and get 10 or 12. So that's the way I look at it. I think there is a shortage of money, but it is a people issue more than it is access to capital. There's capital everywhere, but finding the connection between the source of the money and the people is a cultural thing in some ways. I think it can be done, but I think you got to work at it.
Well, the only thing I would also add, and I'm going to say this again, some people don't have good stories. Some people don't have good proof points.
I agree.
So I'm sorry, but if you haven't got I was talking to Ray Lane a few weeks ago, and we were talking about Beyond Meat, and he was talking about when they got engaged with Beyond Meat. He was talking about the story that made so much sense to them about if they can just get a small 5% slice of the overall, you know, meat market and stuff, how huge that market and opportunity could be, right? He said the story is very, very important, but also sooner or later, you have to have proof points that says that the capital invested is actually delivering value and that there's an economic model around it that makes sense. And
Okay,
so,
that's the harsh reality. One more question. This is a good one that came on the Q&A. What's the, here, let me get it right. What's the single worst thing you could do to hurt scalability?
Miss your expectations. Lose the confidence of your team, of your investors, of your board. So setting expectations properly and meeting them.
I'm going to say 2 things, not one. It's not being able to make a decision and not being willing to change.
That's It's a good one. I like that. You know, I've found over the years that the decisions that make the most impact on the outcome aren't the first or the sort of the ones in the middle that you make to adjust your course, rather than. But I agree with what's been said. I don't know. What I tried to tell my entrepreneurs is see the future, but work today on the stuff that you can do today and create momentum. Back to Tom's point, what I train my entrepreneurs to do is at every board meeting, tell us what you're going to do in the next 90 days, and then come back and tell us you did it. And what you're going to do the next 90 days. So you maintain that confidence of your investor group. A lot of times entrepreneurs spend all the board meeting talking about what they're going to do in 2 years. And it's irrelevant. What you need to do is talk about what you're going to do in the next 3 to 6 months, and then do it.
Yeah.
And if you do that, you gain momentum, you gain confidence, and you get support from your board and your investors.
I'll weave my comment back into what George said. You know, when we started Acquia, we had the founding CEO had a philosophy that, or a business value that he was going to pursue, and they built a lot of product, and 10 months in, they launched a product and nobody bought it. So, you know, in terms of scaling, the company wasn't going to scale anymore, and the investors were ready to shut it down, actually. And that was where this concept of being able to change came in. Everybody's got to be able to pivot. Back to George's earlier point, he found one entrepreneur in his whole history whose business 10 years later looked like the original value.
Right, that's rare.
So it's so rare that you've got to be able to understand that change is fundamental. And we did that at Acquia. We completely pivoted the business, changed the business model, and, you know, instead of shutting the business down, we created a unicorn. So.
Yep. Change is the only constant you face. The sooner you get comfortable with it, the more successful you will be, including your company.
Unfortunately, we're going to have to stop there. I'm sorry for the unanswered questions. Thank you for contributing them. Thank you, everyone, for being here. And a special thanks to the speakers here, who we're so lucky to have all of you in our ecosystem, and hope to leverage your expertise more in the future. Thanks. Thanks, everybody.
Thank you, Kathleen, and thank you, Alan, for helping to set this up.
Thanks, everybody. Bye-bye.